Hello, everybody. Welcome to the Dollar Report. I'm Professor Barth, Associate Professor of History at Arizona State University. If you've watched my videos before, you might be a bit alarmed by the look. I have a tradition every summer of just taking the beard completely off, trying to mustache out a little bit. Hey, don't worry, it takes just a few weeks for the beard to grow back. But anyway, some big numbers today with the release of the new, from the Bureau of Labor Statistics, of the new Consumer Price Index. Inflation rose only 0.2% in June and 3% year over year. Some positive news. As you see here in the headline from Zero Hedge, U.S. consumer price inflation drops to 27-month lows, the longest streak of declines ever. So this is good news for prices. However, core remains stubborn, as we'll see, core inflation. And then also the big question mark, and what we'll focus on in the second half of this video, the economy more broadly. What is the impact of all of the credit tightening, the monetary tightening? Is a recession around the corner? We'll take a look at the FOMC minutes, but first, these inflation numbers. Here's a graph of consumer price index year over year. Undoubtedly, this looks good, all right? 3% year over year is still too high, of course, but this is the lowest, again, in 27 months since spring of 2021. Year over year, just 3%. Month over month, the figures look pretty good. Again, still too high, but, it's we've had a season now of relatively low month over month increases in CPI, especially compared to early 2022 and 2021. This looks pretty good. Core is the big exception, okay? And yeah, core is moderated a tiny bit, but core CPI remains stubbornly high. Now, if you've watched these dollar reports before, you're well aware, core is CPI minus food and energy. Why take out food and energy? Food and energy tend to be more volatile sectors. By eliminating the more volatile sectors, we are said to have a more accurate picture of price movements. Core CPI, if you look at compared to just total CPI, complete drop here, not so much. Total CPI is at its lowest point since spring of 2021. Core, on the other hand, is at the level it was at the end of 2021. Really close to where it was at the beginning of 2022. Not good news. And if anything, it is this number that will cause the Fed to increase interest rates by a quarter at the next FOMC meeting, which is in almost a little less than 2 weeks from now. The FOMC will meet, probably will raise rates by a quarter, and one of the reasons why they'll do that, most likely, there's a chance they'll keep rates the same, but if they raise rates by a quarter, probably the main justification is going to be because core remains so high. Look at that. There just really hasn't been a major decline in core CPI since the tightening cycle began. The Fed began tightening in February of 2022. So we're about almost a year and a half into the process. And here's core CPI since February of 2022. Not much. Where are the results here? It's just not going down as expected. There's another way to look at it, a line graph. Not a very good picture. Here's month over month core. 0.2%. The forecast was 0.3. So 0.2, a little better, okay? But still way higher than it should be. And there's no, it's extremely likely that when we get the July numbers next month, that core CPI month over month will go right back up to 0.4 again. There's really no indication that we have a consistent slowing down of core And so that's going to have an impact on the next FOMC meeting. To look at specific prices, we won't go through all these. Some good news on the food front. Food went up only 0.1% last month. Year over year, it's 5.7%, which is still way too high, 5.7%. But if you compare that to the numbers last year, if you followed my Inflation Nation videos last year, this is better. Now, the June jobs report, which was released what was that, a week or two ago, the June jobs report showed that average hourly wages year over year are up 4.4%. Food is up 5.7%, so working families are still getting hit at the supermarket, just not as grievously as they were as the previous year. And in some sectors, prices have gone down. So in the all-important, in my opinion, meats, poultry, fish, and eggs down 0.2% for the year. And then in other cereals and bakery products, 8.8% increase year over year. If you like to eat out, up 7.7% year over year. Eating out has gotten quite expensive. But undoubtedly, seems like we've hit a season here of lower food inflation, up 0.1% in the month of June. And so really since March, it's been 0.2% or lower month over month increases. That's good news. Energy, good news. Energy prices overall down 16.7% for the year. Gasoline down 26.5% for the year. Natural gas down, electricity up a little bit. Again, energy is a very volatile sector, and there are many variables, of course, that play into energy prices other than monetary policy, which is, again, one reason why we eliminate that from the core reading. And then you go down the line in other sectors, tools, hardware, outdoor equipment, supplies went down for the month, but for the year it's still plus 8.8%. 8.8%. Used cars and trucks are down 5.2% since June of 2022. So if you're in the market for a used car, this isn't a bad market to be in, although your auto loan interest rate's a whole lot higher. But then, so why is core so high? Well, look at these numbers in the bold. Well, so tools, hardware, outdoor equipment, supplies, X factors in the core, that's up 8.8%. But then here in the bold, motor vehicle maintenance and repair up 12.7% for the year, and over the month of June it went up 1.3%. These are very, very high numbers. And then motor vehicle insurance up 16.9% for the year, and in the month of June, up 1.4%. Again, another very, very high number. If you look at how CPI is computed, these two sectors here, two prices, motor vehicle maintenance and repair and motor vehicle insurance, together comprise almost 4% of the total CPI, almost 4%. And look, these are high numbers. So that's a chief reason why core remains so high. That you have look, last December, my wife and I, we have a large Nissan van, had a major repair. It was a couple $1,000. Actually, I think it was like close to $4,000. That's a big expense. Okay, it can really hit you quick. And the fact that that's up almost 13% for the year is significant. And then that vehicle insurance, your car insurance, that bill every 6 months, that's a large bill. And everyone's noticed that that's gone up. So that's hasn't gone away, or hasn't gotten any better. We haven't really gotten any relief from those areas. Airline fares are down. People just don't have the discretionary income to travel. We recently went on vacation, and we took the van that I just described to go cross country. We looked at buying an airline ticket, but I've got to buy 6 seats. Woo, six seats on a flight back east from Arizona. I said I think we'll do a road trip, so we declined to go on the airline. But Shelter up 7.8% year over year, up 0.5% for the month of June. Shelter comprises about almost 35% of CPI. So nearly 35% of CPI is Shelter. That's up almost 8% for the year. That's also included in core. And so that's why, in short, why core remains stubbornly high. There's the federal funds rate. Again, tightening began in February of 2022 when interest rates were basically zero. The upper limit was a quarter. And then, we have that hike. The Fed at its last meeting in June decided to keep rates the same. So right now we're in the 5 to 5.25 range. The FOMC is going to meet again in just under 2 weeks. The projection is that they will raise rates by a quarter. Undoubtedly, there will be pressure for them to keep rates the same. We'll see what happens. I think they'll probably raise rates a quarter, but it's really anyone's guess. If you zoom out, this is since 2015, and so here where we'll transition to what's going to happen to the economy. Okay, and when you zoom out and you look at the federal funds rate since 2015, this has got to have an impact, right? Something's gonna happen. Chickens are gonna come home to roost, because while we noted in the last dollar report, the real interest rate is still very low. If you take the federal funds rate minus inflation, we're still looking at a fairly low interest rate, real interest rate. However, the rate of increase has been so rapid that it's going to have an impact. Now, people have been saying for a long time, including yours truly, Larry Summers has been predicting a major recession since late 2021. And it hasn't happened yet. So everyone's like, what's going on? Well, something's got to give eventually, because that's a major jolt to the economy. It has a real effect on things. And to be sure, it was needed, because after COVID again, I'll beat this dead horse many times in previous videos. COVID, just massive QE. The money supply is up 32% since COVID. Now, in truth, since the tightening cycle, the money M2, which is a main metric for the money supply, M2, since the Fed began tightening, is down 5%, but still, since COVID to the present day, it's still up 32%. So there's just a whole lot of debt, a whole lot. The Fed's balance sheet is still extremely bloated. I saw this chart on Zero Hedge this morning, and the gray is total federal debt since 1970, but since 1990 is what this gentleman is looking at in particular. And just look at what happened in 2008. Just the federal debt since 2008 has just gone completely berserk, and then COVID, just wild increase in the public debt. Meanwhile, if you stack that up against GDP in 1990 was $6 trillion. It's a little more than quadrupled from 1990 to 2022. Okay, that's a big increase, but the debt to GDP ratio is way out of whack compared to what it was in 1990. And then there's inflation. $1 in 1990 would get as far as $2.37 today. But it's the debt. So what's going to happen there? Something's got to give. This is not a sustainable system. Okay, it's just not. There is a such thing as reality in economic laws, and eventually something's going to happen. Okay, and I think right now it's just we're in this weird malaise where people know that something isn't quite right with the economy, but things are still humming along apparently. But lending standards are definitely tightening. The bank prime loan rate is 8.25 now, and that's only if you have good credit and you arrange a good deal with the credit union. Compare that to the beginning of 2022 when the prime loan rate was 3.25. It's going to have and it has had a big impact on small businesses, on consumers. The 30-year fixed rate mortgage has been hovering around 6.5% to 7% since the end of 2022. That's had a big impact on the housing market. People just aren't willing to sell their homes in this market because if you locked in a rate down here at 3%, why would you surrender that? They call it the golden handcuffs. And so anybody who's entering the housing, who wants to buy a home in this market, not only are you paying a higher mortgage rate, but there's just a shortage of homes on the market. And so that's led to a construction boom, but which further contributes to the housing market bubble. So a whole lot of distortions in the housing market that are yet to be, the consequences of which are yet to be, remain unknown. The Dow Jones remains steady. Went up today with today's inflation reading. I think some people on Wall Street are hoping that the Fed will keep rates at 5.25. Again, we'll see. And then the Treasury note, the 10-year Treasury, the yield has really remained hover around 3.5% to 4% since the end of 2022. As we've noted in previous videos, it's going to cause problems for banks and various institutions that purchased treasuries at this low yield. If they have to sell those on the open market, they're going to take a really big loss. So we'll keep our eye on this number as well, but it's been hovering around the same price since the end of 2022. The June jobs report was fairly positive. Unemployment is, I think, 3.6%. That's very, very low. And then, of course, at the last meeting in June, the FOMC kept rates steady, but forecast 2 more hikes in this calendar year. And so, again, it's likely we'll see another rate increase in 2 weeks. Now, the minutes for that meeting in June were released recently. Didn't have access to them in our last dollar report. Let's take a look at some of that. There's some interesting info here. First of all, the staff noted that market participants, as people involved in the economy, interpret incoming data as signaling on balance more resilience in economic activity than previously assumed. Again, everyone was predicting a recession by now. Hasn't happened. The economy's been more resilient. Consumer spending so far this year has been stronger than expected. Sounds good, right? Well, there are signs that consumers are facing increasingly tighter budget constraints. There's no doubt about it. One of the reasons for that is borrowing costs. In domestic credit markets, borrowing costs for businesses, households, and municipalities increased notably over the intermeeting period. Small businesses and households saw continued increases in their borrowing costs. Interest rates on credit card offers continue to rise. Remember, that credit card, you got a variable adjustable rate. And there's, I think, something like $1 trillion in credit card debt. What happens to that credit card debt as interest rates continue to rise? Both credit card and auto loan interest rates stood at or near their highest level since the global financial crisis. Some participants judged that it was still too early to assess with confidence the eventual effects of tighter bank conditions on economic activity. We don't know what the effect of all of this is going to be. Now, the forecast prepared by the staff for this meeting, they're forecasting a mild recession starting later this year, followed by a moderately paced recovery. Now, this supposed recession that's coming is, they keep pushing it forward. Okay. Now they're saying later this year there'll be a mild recession followed by a moderately paced recovery. Real GDP was projected to decelerate in the current quarter, that's the second quarter, and the third quarter, so decelerations in second and third quarter for GDP, before declining modestly in both the fourth quarter of this year and the first quarter of next year. This is not good news if you're the Biden administration. if there's one thing that can predict a loss in a general election, that's if you're the incumbent and the economy enters a recession the year of an election. And here the prediction is that GDP will decline modestly in the fourth quarter of 2023 and the first quarter of 2024, but it gets worse if you're the Biden camp. The unemployment rate is forecast to increase this year, peak next year, presidential election, and remain near that level through 2025. I think one of the reasons why the Republicans were unable to capitalize on the poor economy in 2022 during the midterms with all the inflation, one of the reasons why they were unable to capitalize on that was because unemployment was so low. What happens if unemployment is high, or if it's even just moderately high? That's a game changer. But then the FOMC admits they don't really quite know. Given the continued strength in labor market conditions and the resilience of consumer spending, however, the staff saw the possibility of the economy continuing to grow slowly and avoiding a downturn as almost as likely as a mild recession. I like that. Almost as likely. So still the mild recession is the most likely. They don't really know. Nobody really knows what's coming around the corner. I think it's pretty safe to say there's got to be a downturn. There's going to be. The question is when and how severe. That remains to be seen. Participants acknowledge uncertainty about the lags with which monetary policy affects the economy. The full effects of monetary tightening on the economy have not been realized. This is a very important principle I've talked about in several videos. There is a lag between monetary policy decisions and the economic effects. Look at what happened during COVID with all the QE. Inflation didn't kick in right away when you got those checks in the mail and the Fed increased the money supply by some 40%. It didn't happen right away. It lagged. It took some time. Well, in the same way, monetary tightening, it takes some time before it impacts the broader economy. This has always been true throughout monetary history. In my book on money in colonial America in the 17th century, you saw this over and over again, where a colonial government would change the nominal price of Spanish silver coins, and it took a while for that monetary policy decision to affect prices across the board, to affect the economy across the board. In the same way that it's true today, we don't yet know the full effects of monetary tightening on the economy. Regarding downside risks to economic activity, participants noted the possibility that the cumulative and rapid tightening of monetary policy would eventually affect economic activity more than expected. That's not good. And that the additional effects of the tightening of bank credit conditions could prove more substantial than anticipated. While total inflation has moderated over the past year, core inflation, as we saw earlier in this video, has not shown as sustained easing. Declines in inflation have been slower than the FOMC expected, and core goods inflation has slowed less rapidly than expected. That has not changed with this latest report, which is why I think they will increase rates by quarter. Could be wrong. There will certainly be a lot of pressure on the Fed to keep rates the same at this upcoming meeting. So it's anyone's guess. But against this backdrop, again, this was the June meeting, almost all participants judged it appropriate or acceptable to maintain the target rate at 5 to 5.25. Most of these participants observed that leaving the target range unchanged at this meeting would allow them more time to assess the economy's progress. And here again, and I know I beat this drum every video, but this gets to the core problem of the Federal Reserve. One of the core problems of the Federal Reserve, and that's central planning. This idea that this board, that this committee, can have anything approaching the knowledge and information adequate to decide what the price of credit what the interest rate should be, instead of allowing the market to decide that, or what the money supply should be. Back in the gold standard days, the price specie flow mechanism determined the money supply of a particular country based on, if there was an oversupply of coin in any particular country or region, then imports became extremely cheap. Exports from that country became extremely expensive, and so you had an outflow of coin from the area in which there was an oversupply, and worked in a reverse as well. If there was an undersupply of coin in a particular region, if there was a deficiency of money, then imports became very expensive, and exports from that country or region became very cheap, and so people from the outside brought their coin into that country or region, which then filled that demand. It's all supply and demand. Well, with central planning, they don't have that. You don't have the price mechanism at work. Hayek wrote a lot about this, and if the subject interests you, I encourage you to look into some of his articles and books on that subject. But probably Hayek's best contribution to economic theory was his appreciation for the price mechanism and the price system, and the fact that these committees, these central planners, do not have the knowledge necessary to determine the correct price, and the Fed is so guilty of this, and it leads to major distortions. I don't know what the correct interest rate should be per se. Okay, nobody does. It should not be. We should not leave it to this committee to do it. And then the other problem with the Federal Reserve is that, again, that the committee consists of people who primarily come out of, or almost exclusively come out of, the financial industry, and so they have their own agenda and biases in place while they're making these decisions, as we saw in 2008, and really throughout the Fed's history. These financiers and hedge fund managers and bank CEOs who make these decisions at the Fed, so much of the public trusts that the Fed is doing this for the public's best interest. But history tells us otherwise. And so there's just so many problems with the Federal Reserve. It's what we have right now. What should the Fed do? It seems to make sense to raise rates by a quarter at the next meeting, but what do you do with an institution like this one? Some participants, and this was actually a very big takeaway from the minutes. We didn't know this back when I made the last dollar report video, but the minutes revealed this. Some participants at the June meeting indicated that they favored raising the target range by 25 basis points at that meeting. So there were some who dissented and wanted to raise rates by a quarter. Ultimately, the Fed decided not to. And the ones who favored raising rates at the last meeting noted that the labor market remained very tight. Momentum and economic activity had been stronger than earlier anticipated, and there were few clear signs that inflation was on a path to return to the committee's 2% objective over time. Almost all participants noted that in their economic projections that they judged that additional increases in the target federal funds rate during 2023 would be appropriate. So we'll see. We'll see what they decide to do, and I'll check back in with you later. And until then, God bless.